Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk, the weekly review. It's Friday, the 20th of March, 2026. Every week, myself and a guest will break down the key story of the week just gone and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up to what you should be looking out for. For this episode, I'm joined by Vincent Deluard of StoneX Markets. Vincent writes weekly commentary on the markets. He's also a director at StoneX, and we're very lucky to have him as a first-time guest on this episode. So I'd like to welcome Vincent. Vincent, how are you?
Very good. Happy to be here.
Awesome. Yeah, so Vincent authors weekly research reports on global macro trends, flows, European capital markets and quantitative topics, and advises large pension funds and other institutional investors on asset allocation and risk management. So very well versed in what we have going on at the moment, and we're really lucky to have him on the show. Before we get into it, though, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, let's get into the reads. So the week just gone was one of the busiest weeks I think I can remember for a while now in terms of central bank announcements and rate decisions. And we were headlined by the FOMC rate decision on Wednesday. As expected, they kept rates on hold. And really set the template for what we saw from central bank messaging throughout the course of the week, obviously referring to the the Middle Eastern war between the US, Israel, and Iran, and really the uncertainty and the volatility within the markets that's created, and the headache it's causing now for central banks who were, to the most part, on an easing cycle. It's kind of paused that in its entirety. Vincent, I want to bring you in on the FOMC then, rate decision, obviously as expected, but what did you take from the messaging that we got from Fed Chair Powell?
I think the surprise was a little bit of defiance against Trump. On the decision, it was obvious, there was no big surprise in terms of what they would do, or even the guidance or general tone about the path of rates and the old shock. Well, what I thought was more interesting was Powell defying Trump and saying, hey, I'm going to stay here until the investigation is closed, and not taking the bullying. And it seems to be a pattern now for the Trump administration, where Supreme Court first did on the tariffs. We had a Lisa Cook decision, now of Jay Powell. So we are seeing more resistance against this kind of takeover of monetary policy. And I think that's the reason why the market interpreted this meeting as hawkish, even though if we purely look at monetary factors, it was not that hawkish.
That was my question. Yeah, that was a question I was going to ask, because that interpretation, like you said, the interpretation was, oh my God, we're going to get they wiped out the idea of rate cuts this year, and now starting to pricing at least a hiking factor, if not a cut very much late into the year. And like you say, really there was nothing that committal from Powell to suggest that was the case. And I'd suggest, and we can talk about other central banks in a minute, the same could be applied to the Bank of England, for example, or the ECB, well, less so the ECB. So in terms of Powell and the political situation, how much do you think that gets in the way, from your perspective, as as someone who advises investors or invest or whatever. How much is that noise getting in the way of trying to decipher and figure out where interest rates are going at the moment?
I mean, or or else equal the fact that Powell wants to stay. I think he's giving a bit of a permission structure to other FOMC members to show more independence. So I think that's what the market's reading. I mean, on the monetary, I mean, I'm always highly skeptical of these dot plots and these forward guidance. I mean, historically these things never work.
Right,
And why would they work when we have such a massive uncertainty at this point? I mean, the path of monetary policy is entirely dependent on the conflict where headlines are changing every second. So yeah, there were some dusts that were moved. I mean, on the margin, it was kind of hawkish. But again, I go back to this idea that what matters is we had someone who was personally attacked by Trump. There
mm,
was an attempt at kind of reshaping the FOMC, and it looks like the institution is resisting. And I think the more you see people resisting and not losing, the more you incentivize people who might be on the sidelines.
right,
Oh, now it's safe for me to get out there. So I think what this means is this idea that we'd have kind of a Trump Fed after May was probably excessive. And I was always on that view. I think the market has generally been very complacent about rate cuts, always kind of uh, seeing the glass half full when it comes to half
right.
empty when it comes to economic growth, and looking for excuses for rate cuts. And that case was never there. And yeah, it's going to be. Um, I mean, obviously, the longer the war lasts,
Mm.
the the harder it's going to be. The political situation is turning against Trump. So yeah, overall, a hawkish meeting, not so much for what it said, but for what it symbolizes.
That's very interesting, actually. I want to move on to, and it's kind of the same thing, but the other central banks. Obviously, we had the ECB, we had the Bank of England rate decisions on Thursday. The Swiss National Bank left rates on hold as well. I mean, we had some like at least 10 major central banks across the week. And generally, other than the RBA, for example, the messaging was pretty much the same. If we look at, say, the Bank of England and the ECB, slightly different camps there. Bank of England messages, they left their rates at 3.75%, and that was deemed a hawkish hold, especially as all 9 members voted the same way to keep rates on hold, which again, the market was generally looking for a 7-2 split, with 2 doves looking for cuts, continue to look for a cut. Were you surprised by the voting pattern and by the messaging? And I say that under advisement because, again, it comes with a caveat that I personally, I don't think it was as hawkish as maybe the market's taking it.
Yeah, I absolutely agree with you. I mean, what's happening in the gilt market is
If anyone doesn't know,
really,
we've had the gilt yields have soared again, and
yeah,
bonds of the gilts have come under a lot of pressure this week.
yeah. I mean, of course, there are like slight differences in tone, but again, I mean, if we think in terms of like the macroeconomic impact of this shock, it's more or less the same. I mean, uh, between Europe and the UK, the economies are so integrated.
Mm,
If anything, the UK is a bit has a little bit more oil than Europe, so you could argue that it should be a little better off. And then you see this massive divergence in 2-year yields. I mean, in the UK, I think
mm.
we're about 100 basis point higher than before. While in Germany it's probably around 60, and in the US it's around 40. So I'd question how sustainable that is. I think there's an element of yeah, nervousness in market, and when you're very nervous, you you kind of give a big premium to liquidity, and
Mm,
unfortunately, the gilt market is not the most liquid. The UK is an import of capital, so it relies on foreign capital more than say Germany. It's not obviously not as deep as the US Treasury market, so um, it feels a bit unfair. But it seems that every time we have a macro event, uh, the um, the gilts end up being bullied, whether they've done anything wrong or not. And maybe the BOE was trying to get in front of that by trying to kind of convincing the market that it was serious. But if that's the case, that's badly backfired.
It has. Do you not think that's something to do with the fiscal picture at the moment as well, though, and the lack of confidence in the current government's financial framework and objectives, and lack of confidence in the Chancellor of the Exchequer, or the Finance Minister, for example?
Yeah, but I mean, these are not. I can't find that. That's a yes. That's a structural problem in the
Yeah,
UK. I mean, we can go all the way back to Liz Truss.
let's not.
We had, we had the mini budget crisis. So there is this um, kind of endemic
Mm,
budget issue. But if we think about that specific move, why w- there's nothing that changed fundamentally in the budget picture between
sure.
like 2 weeks ago and the last one. So I would blame it more on liquidity factors. And again, I mean, it's currencies and rates is always kind of a reverse beauty contest, right? You're not looking for the most beautiful one; you're just looking for the least ugly one. Who are we going to compare that? I mean,
Mm.
do you have a lot of confidence in the French budget? No. I mean,
That's a good point.
if anything, we have a slightly higher deficit. We couldn't, it's been what, like 3 years since we even could pass a budget. We just kind of pushing forward the old one. The political landscape is completely in rubbles, and
Right.
yet you look at the French government bond, the OATs, they haven't sold off quite as bad as
Mm.
the gilts.
That's a very good point, actually. And like you say, it's for the second largest economy in the eurozone. That there should probably be more of an impact on that level. I get it. So if we're talking about Europe then and the ECB, do you see a higher likelihood of rate hikes there? I mean, I think people were starting to talk themselves into a hike at the back end of this year anyway. So it was just as an easier leap for the European central bank rate markets in that sense.
Yeah, I mean the curve is pricing about 3 hikes now in
Oh,
Europe,
okay.
up from zero. Uh, Again, all of that really comes down to the war,
Mm,
and so I would put a huge caveat on all these forecasts that 2 months from now we may have a completely different picture. But yeah, it's been a huge shift. In general, central banks tend to freeze when you
yeah,
have energy shocks. And then the idea is, hiking or cutting rates does not produce oil. So you're really not helping either way. And then whatever you do, you end up being blamed, right? Because if you hike, well, you're basically an oil shock is the definition of a stagflationary shock, right?
sure.
Where the inflation goes up and the economic performance slows.
Mhm.
So it's a heads I lose and tails I don't win for the central banker. If you hike, you're hiking even though the economy is slowing, and if you cut, you're cutting, and so because as inflation is accelerating, so you miss you're gonna miss one of your two mandates. So that's the default is generally to just kind of freeze and hope it goes away. Um, the issue here, of course, is we come on the back of really more than 5 years without of above target inflation.
Right.
And that's the problem of the boy who cries wolf too many times, right? I mean, if you, I think 5 years ago, the market would have a much greater tolerance for, hey, this is just a temporary price shock, and
Sure.
I'm just going to wait it out. Now the market is you need to give him to give the market something to show that you're serious about inflation risks.
Okay. I want to move on then to again what we're looking at. This is Middle East conflict. Where are we at right now? Um, we've seen an escalation this week, I think, in the violence, in the amount of missiles that have gone back and forth, and just general violence. Everyone's still predicting. Like I think there was a guest we had on that said that the general consensus is around 6 weeks this war will last. Knowing no one truly knows how long it will last. Um, but again, as an investor, as someone who advises, what do you do if this is a short-term issue at the moment that could potentially escalate into a mid-term or long-term problem for the markets and for investing. So, how do you manage the situation like this at the time? Do you just pull out of everything right now and just play that very safe game, or you've been a bit more circumspect and just stepping back a bit and just saying, look, well, really, what's changed near term at the moment? How do you manage that risk?
Well, I think whenever you look at markets, it's really about what's priced versus what's not priced,
Okay.
and what the balance of risk is. Um, and if I just look at equity indices, uh, listen, I mean, we're what 5% from the all time high.
Yeah.
So I would argue there's not that much priced in the equity market. We've certainly seen, we're discussing that the bond market is starting to move.
Mm.
And in general, I tend to be um, more worried about the bond market because um, it's a hard constraint on governments. And if you see a yield shock, um, like we had in the UK, close to 100 basis point, I mean, this creates its own reality. So
Yeah.
if I don't think the equity market has really reacted all that bad, even the oil market, to be entirely honest. I mean, if you had told me 3 months ago that we would have the Strait of Hormuz closed, that would have decapitation strike that did not work in Iran, that would have missile flying, including on like Qatari gas field that supply 20% of the world's LNG. That I just saw today some missile hitting Jerusalem. Um, I would have thought that Brent would be much higher. I don't know, probably today's around 109, maybe a little bit less on WTI, but um, we could have been a lot higher. Now, why is it not higher? Is I think a perverse logic, which is that the market realizes how bad this is, but then
Okay.
precisely because it thinks it's so bad, it thinks it cannot last. That's the catch 22 of the taco trade. So
Right.
taco is this acronym that came about on the tariffs. Trump always chickens out, right?
Hmm.
He has this maximalist position, which you could argue is kind of some sort of art of the deal magic, and then eventually he chickens out. But so he gives up 90% of what he started to bargain with, but since he started from such a maximalist position, he ends up getting something out of it. Um,
Right.
First of all, I don't really think that applies. I mean, that maybe that applies if you're like trying to buy a building on Central Park West, but we're dealing with people's lives. We're dealing with the lifeblood of the economy. So I'm not sure that this is a negotiation technique. But even so, there is this contradiction that as long as you believe that Trump is going to chicken out,
Yeah.
uh, you don't sell. Now, what is the thing that makes Trump chicken out is pain, asset asset price pain.
Right.
Remember back in during the Liberation Day tariffs, there was this famous quote: "Well, the stock market, the bond market was getting jittery,"
Mm.
and that's when he backed down. Now, if that never happens, can keep going, and I think that's
Yeah.
exactly where we are. So it's this catch-22. For the tackle to work, people
Mm,
need to stop believing in it. Now, I'm starting to see signs that this is happening, mostly on the kind of short-term rates, although we're starting to see some long rates moves as well. But
mm,
I would argue that there needs to be more pain at this point, and then that's why I've heard also that 6 week thing. I don't know where it's coming from. By the way, are
no,
we counting from February 28th? Is that
exactly
the
right.
start?
Yeah.
So we would be already halfway through. So 3 more weeks. So is it from here? Um,
Mm,
I mean, from what I've seen, it's just, you know, he threw
yeah.
that number out there. I mean, he thought it'd be done in a weekend, and there's like, well, but I really don't see it as a kind of a hard deadline, and I worried that it can last a bit longer, and the less damage we have, um, the more it lasts. Again,
Mm.
because from Trump's perspective, you know the initial strategy did not work. But at this point, it's kind of a bomb and hope strategy. Like, well, you know what? If
He's in it now, basically. So, for his perspective, he's in it now, so he might as well see. But do you think then it will take for the equity markets to turn? Because we know that he's super sensitive to the equity markets. He's super sensitive to 401ks and all that sort of stuff. Is that the tell, do you think, for him that, right, okay, that's it now? Once he starts to see that confidence, because apparently his popularity ratings are pretty much in the dumpster at the moment, and he's not getting a lot of love for this war at home, from all interpretation. So, does he care because it's his last term in office, and this? There's so many different factors that we really don't know, because who knows when it comes to the president. I guess we could talk about this forever, but I want to go on to really just a quick look at the. I guess we're looking at the week ahead, and to see what we have. Um, make sure I got the right one. Really, the week ahead, and just looking at what is going to come up. I think it's a fairly quiet week next week. So, in your eyes now, are we waiting for the Fed, for example? Are we simply waiting for again, they stay for the headline news on oil at the moment? From the Fed, what will you be looking out for in terms of indicators to give you a bit of a tell on when they start believing the time is right to hike, or even to stay on hold and maybe wait it out? Is there anything particular you'd be looking at in that instance?
I mean, again, you have this massive Damocles sword of the oil market,
Mm,
and it's not just the oil market, right? It's the fertilizer. I mean, it's the copper. I mean, there's so many things that are the longer the straits remain closed, the
yeah,
more disruption we see, and my guess is that we're going to see in places that you just don't expect it.
right.
It's going to be some weird shortage of, yeah, I mean, even antibiotics for India is a big,
Mm,
you know, we're really going back to a lot of the issues we had during COVID, where you realize that kind of everything is tightly integrated, and then there's just like this chain of events that leads to unexpected consequences. So uh, that's again, that's what's going to drive everything. Now, in terms of non the big question for the Fed was really the state of the labor market.
right.
That was the case before for rate cuts. It was the view that the labor market was weakening. We had this very bad job report for February, where we had a
Hmm.
92,000 jobs lost. Now the question, was that a fluke, or was that the start of a breakdown? Now there's this theory that the labor market is kind of the quote by Hemingway about getting bankrupt gradually, then suddenly. All right,
Yeah.
so we had kind of the gradual weakening. Basically, for a year now, we've seen dwindling new jobs. And
Hmm.
are we at the suddenly point where companies start to lay off workers, and then because workers are laid off, uh, consumption drops,
Right.
and that becomes self-fulfilling. That's the sum rule logic. If you remember, 2 years ago we already went through one of these.
Hmm.
The idea is that when the unemployment rate starts to go up, it goes parabolic. I would take the under on that. Now that's before the Iran situation,
Right.
of course. Uh, but my personal impression is that the labor market was more resilient than the market gave it credit for. I think the investors were looking for excuses for the Fed to cut. The Fed itself, all your water, your Kevin Walsh,
Yeah.
there was this kind of Kevin Hassett. There was this war to try to fit inside the data what the
Mm.
boss wanted, which was rate cuts. So, uh, all ex Iran, uh, I would think I would have guessed that the economic data would come a bit stronger. That whatever weakness we saw in the labor market had to do with the government employees being fired with Doge. Then we
Sure.
had the shutdowns, and then finally, of course, the supply effect. I mean, the U.S. labor force is no longer growing. Now, there's the question, of course, of what does elevated oil prices do
Mm.
to consumption and investment. And again, we go back to this idea: how long does this last? If this lasts just 6 weeks, yeah, maybe it's just a blip, and we go back to my basic view that we have fundamentally a very strong economy.
Okay.
And I would argue possibly even some stimulus, because at the end of the day, war is a massive stimulus. I mean, it's a very unproductive kind of stimulus, but
Mm.
we're spending more than $1 billion. Uh, uh, we just voted appropriation for 200 billion. So
Sure.
one possible surprise would be that, at least in the US, instead of that recession that, now we see kind of everyone talk about it. And you can
Mm.
certainly see recessionary effects in East Asia, in Europe, but in the US, we can actually have um, I wouldn't say nominal growth shock,
Sure.
mostly because of high inflation and high government spending down the line.
But you've seen a resilient household consumption. You've seen resilient consumers out there. So, like you say, to lend to your argument, uh, it's got through the worst of it so far in terms of what people thought, and we've still seen, as I said, someone did mention that we were looking. It was maybe eating into savings, and maybe the savings rate was being degraded, and that was keeping the consumer in the market for the time being. And as that you know starts to empty, then we may start to see the other side. You don't follow that assumption, or you think even so?
Yes, but I caution that it takes longer than people think.
Okay.
The savings rate has been going down for some times now. It's not negative; it's at about 4%.
Right.
Um, and I what matters is not just the current savings rate, but the
Mm.
path of the savings rate. I mean, we had 25% plus savings rate during the lockdown.
Right.
These excess savings are they're still in the system. I mean, you look at money market funds, for example, which are funds where you can put some extra cash. I mean, the balance is at an all-time high here.
Okay.
So there is still a lot of money in the system. And the second part is it's not just about savings; it's also about asset prices. I mean, the
Right.
reason people save is because they want to buy a house. So if your 401k is at an all-time high, if your home price has appreciated by 50% and you got to borrow at 2%
Mm.
5 years ago, you need less savings. So this narrative that the consumer is going to tap out. I
Mm.
mean, I've heard it for the past maybe 5 years now, and it still hasn't happened. Now, again, we go back to this question about the Iran war. Is this the one bridge too far, right? Is it the shock that
Yeah.
finally tips us over? My default assumption is I'll be like St. Thomas. I'll believe it when I see it. Right now, I am not seeing it. One thing I like to look at is travelers at the TSA checkpoint. So if you ever travel to the US,
Yeah.
which is a very unpleasant experience these days, um, you know,
I've
You
not
have
traveled to
to.
the US for about a couple of years now. I've been to Canada, yes, but not to the US. So I've yet to find that nicety. But I will be traveling soon, so I'll find out.
So, wow. So you will go through, TSA, and you have to take off your shoes and check if your toothpaste contains any sort of explosive device.
Right.
But the nice thing is we do get a count there, and I
Hmm.
naively expected, given everything that we see, that the fact that Dubai is the world's largest airport,
Yeah.
that we see a fall, and now we're on an all-time high. So uh, again, it's maybe still very early. Maybe people, it's like, well, if you had the people who are traveling today probably had bought their tickets before the war,
Right.
so you may want to wait a couple weeks to see that. Um, Dinner reservation, OpenTable is a website that allows you
Mm.
to make booking there. It's up by 10%, which is kind of shocking because if you want to go out in, say, Miami Beach, I mean,
Yeah.
like a basic low quality, really bad Cuban food on Miami Beach is gonna be like, $200 for you and your date, and then you don't even have wine for that.
Yeah.
But still, so again, it's possible that things are about to change.
But you're
Um,
just not seeing that reflected in the data that you.
Correct. Like
Yeah.
again, I think the sequence remains. We need to see the pain in the asset prices
Yeah.
first to get some sort of geopolitical solution and also some macroeconomic effect.
Mhm.
We have a very wealth driven uh, economy.
Right.
The top 10% accounts for more than half of consumption, and for folks that are doing well, it's not like, yeah, gasoline prices are very high. I mean,
Mm.
California right now, probably the highest. It's the highest in the country, but
Hmm.
for people with who own their homes, who have large 401k balances, who have tech job, it's not a significant in part of your budget that you spend on gasoline. So
Sure.
I think that again, the path is for asset prices to come down before we can have any sort of both economic impact and geopolitical impact. And again, I think that's the the market has it backwards, right? It kind of wants to see economic damage, and then no, it's
Yeah.
it's not the economy is the market. It's the market that leads the economy.
Oh, one of my favorite phrases. Listen, I'd like to thank you. I mean, we're coming to the end of the episode now. Just a quick note for our listeners and on out there that the week ahead we've got composite PMI data. So not only for the eurozone but across the globe as well. So, Vincent, we may well see from that survey evidence um, some of the tell signs that you're looking for before you're convinced that things are any different. So we'll get some survey readings coming out next week. Across the globe, you've got Australia inflation. It's an inflation week for a few of these nations next week as well. So it's going to be interesting to see. In the UK, we've got February inflation. We were looking at a disinflationary picture for the UK. Obviously, even if we do see it in the near term data, looking into the very near future, that may start to turn around. We've got retail sales looking at the consumer in the UK as well. There's not a great deal in the way of US data. It's been a bit skewed in terms of the timings of late. More survey evidence from Germany's IFO Business Climate Index for March. We saw the ZEW expectations index tank into negative territory as well. We do have Canadian payroll employment change data for January drop next week as well. But as we've noted, as Vincent and I have said, it's all about the oil and the persistence of the rising oil prices at the moment that will probably dictate sentiment in the near term. And again, it's a fluid situation where we just, at the moment, I think all bets are off, which is hence why we saw a lot of central banks come out in a wait and see mode. I'd like to thank my guest, Vincent, for, again, as a first time guest. I very much appreciate you coming on. I'd love to have you back again. because I found what you said insightful. And I don't want to say it goes against the grain from what others have said, but it's interesting to take your perspective on what we've seen in the markets and what we're likely to see in the near term. So thank you very much, Vincent, for taking part.
A pleasure. Good luck and stay safe. This may not be over as quickly as that 6-week quote, I'm afraid.
No, sadly not. But listen, Vincent, thank you very much. Anyone who wants to go back and listen to this in its entirety, please go back to the social media, our social media, or you can find us on Spotify or Apple iTunes or whatever, and pick us up there. So again, have a great weekend, as Vincent said, and I echo this. Stay safe, and we'll see you again next week for another episode.